Ho, ho, ho! Merry Christmas! Hi, this is Todd Baker, and I want to wish you and your family a very Merry Christmas and a healthy, happy, prosperous 2025. And in this season ending Todd Talks video today, I want to share with you the expert predictions for 2025 and then share mine. I'm also an expert. After 20 years of doing this, that qualifies me as an expert. So I'm going to give you my insights based on what is actually being predicted so you can make great decisions about purchasing or refinancing or whatever your home finance plans for next year. So let's dive right in. So this is a chart of Fannie Mae, Mortgage Banker Association, and Wells Fargo. So three different institutions predicting rates, what they're saying they're expected to ease and stabilize. So for the end of the year, Q4 of 24, where we're there right now, you can see Wells at 6.8, MBA 6.6, Fannie Mae 6.6, average 6.67. Let's see where we actually ended up at based on that. We are at 6.92. This is for conventional, the government rates, or for VA and FHA, it's lower, but right now the average is 6.92. And you can see they hit 6% in September, and then in Q4 they were about 6.7. So pretty close, but the last few weeks they're a little bit higher. But the thing about it is that you can see they're only predicting as low as 6.33 by the end of next year. So let me tell you my take on it. The Federal Reserve is going to meet. I'm recording the video the day of the meeting. So this Wednesday, today, this is going out on a Friday, the Federal Reserve is expected later this afternoon to lower their benchmark rates. Well, let me tell you what that impacts. Adjustable rate mortgages, home equity lines of credit, car loans, RV loans, boat loans, and business finance. A lot of finance. However, notice I didn't say one thing. Fixed rate mortgages. Those are bonds. Those are controlled and they follow along with a 10-year treasury bond. And so there's no direct linkage. And you can see when the Federal Reserve, when rates were at 6.6, 6.1, that was before the Federal Reserve cut rates last time. And look what happened since then. They actually went up. Now, long term, as the Federal Reserve starts to cut rates, rates will come down. And what will really cause rates to go down is a recession or even a mild recession. And the early indicators of a slowdown in the economy is always the construction sector. You watch it starts with permits being pulled and housing starts, those two. And what we're seeing those at a recessionary low. As those start to go down, the next thing that follows along in that path is like a chronological order of how it rolls out is construction workers start to slow down. That has always been the first for sure sign of an economic slowdown. It looks like we might be going in there. Now, that would help interest rates. That would help the Fed start to really cut aggressively, and the 10-year bond, the yield on the 10-year bond will follow suit, and you will see mortgage rates come down faster. My prediction is that we're going to see rates probably as an average in the upper fives, or even if they get to the low sixes, you're going to be easily able to buy it down in the upper fives at one point. And for those of you sitting on the fence, we've already know for sure through studies and also through buy downs and different promotions that have been out there that 5.75 is the magic number that gets people off the fence and into the market. And we don't have enough inventory. That will immediately put price pressure on, and it'll eliminate your ability to negotiate a reduction in price, a reduction, or use that same reduction to do a great finance package or eliminate closing costs. That will all be off the table if you wait. So if you need to wait, that's one thing. If you're just waiting for lower rates, it is not the right move. You should buy now and I'll restructure you later. So now let's take a look at what is the prediction for prices. Okay, so home prices are expected to grow. Now that we did a much broader survey for 2025, and you can sort of see down here, it's Wells Fargo, Bank of America, Goldman Sachs. Let me see if I can read some of this. Fannie Mae, Housing Wire, Morgan Stanley, Zillow, CoreLogic, MBA, Freddie Mac. So everyone sort of chimed in here. And Wells Fargo is one of the most aggressive. Then AEI Housing Center, they're the most aggressive. So the average was 3%. But here's the thing about that. That's a national macroeconomic level, okay? In certain states, like in Texas and Florida, and for example, we have a higher level of inventory. We're seeing more price reductions, so we might see more moderated growth. However, it's always very local. Keep in mind that real estate is a local. So what's going on nationally or even in Texas regionally. So for example, Austin is in much worse shape as far as sellers, days on market than we are here in North Texas. But the key trigger is this. There's not enough homes. We have a systemic housing shortage in the United States. It's 3.7 million units right now, nationally, housing shortage. And the problem is we're never going to fix that because builders will only build based on demand. With demand being low right now, what's happening is you can see housing starts and permits dropping, which means they're not starting anything new. The backlog of existing home, what they call spec homes or available homes, inventory for builders is rapidly vanishing. And what's going to end up happening is as rates come down in the next year, you're going to see the people come out of the woodwork to sell their house. So when somebody sells a house, that creates a 1 unit of inventory. But that person's also a buyer, so it's a wash. So unless they're moving out of state, which most people aren't moving away from Texas, then it's a wash. It's a 1-to-1, and therefore you have a limited inventory. So then you have a lot of buyers, fewer homes, and you know what that means? That means higher prices, overbid listing, and even with the lower rate, you're going to end up paying more. And I've done math on this in the past. A lower rate at a higher price costs more than a higher rate with a lower price, the way it works out right now, particularly with the concessions. So keep that in mind. Now, if you're just sitting on your house, I'm gonna tell you this. Here's my prediction though. I'm gonna say 5, worst case, most likely 6%. It's what I said at the beginning of this year. The same survey predicted very conservatively last year, an average of about 3%. I predicted over 5, and we hit 5. So my prediction for last year was correct on the pricing. So we'll see how we did at the end of the year. I hope you all, like I said, have a great holiday season. And I am here to help you. As a certified mortgage planner, what I do is I help you develop a mortgage and a structured mortgage that gives you the best cash flow, the lowest expense, and the highest net equity long-term into the house. That's what I do. Totally different than every other lender you're going to talk to. So reach out, give me a call, and I'll put a great mortgage package together, whether you need to sell and buy, or whether you just need to buy for the first time. I'm here to help you. Thanks so much and have a great day.